Hi everyone, Sascha Gödel here, and thank you so much for joining me on today's training, which is titled How to Build Wealth in the Stock Market Without Ever Having to Worry About Any Market Crash Again. I've created this training specifically for those of you who would like this to be your breakthrough year. The year when you stop losing your hard-earned money like you did in all the previous market corrections and crashes, and instead start investing in a smart way that lets you avoid all those painful losses and allows you to grow your wealth in a consistent, safe, protected, and simple way. So if that's you, please pay very close attention, because over the next 30 minutes or so, I'm going to show you how to do exactly that. I'm going to show you how to build a portfolio that can weather any financial storm, which is easy to set up, simple to manage, and has been used by the rich to build wealth consistently. This portfolio will give you control of your financial future and makes you independent of any financial advisor. And the best of all, it will give you peace of mind, which is so invaluable in today's volatile times. I'm also going to show you a unique stock market timing system that will allow you to navigate the ups and downs of the market with ease, and that puts you in a position where you're always on the right side of the market. So if that's something you'd like to learn, then you're in the right place. I actually started this project that I will share with you today about 2 years ago. Up to that point, I had coached and mentored many people on how to invest and trade their money in a smart way. But this was always only on a one-to-one basis. And because my time is limited and I was limited in the number of people I could help, and I decided I wanted to change that. The idea was simple. I wanted to teach the people of the world how to invest like the rich, help them protect their investments from any major market crashes or corrections, so they could build wealth and achieve the highest levels of financial prosperity and security possible, and never have to be victims of the wolves of Wall Street again, like they were in 2008. Now, there are many different ways to build wealth. You can do it with real estate investing, you can run your own business, or you can invest in the financial markets. A lot of people neglect using the financial markets because they say they are too busy. It seems too complicated and overwhelming to learn about it, or they are simply afraid of putting their money at risk. And the truth is, it can be challenging, complex, and time-consuming to learn to invest in the stock market and start building wealth this way. But what if there was a simpler way to get started that requires very little time and is very effective and safe to use? And that is what I would like to show you today. But before we dive in the training, is it okay if I tell you just a little bit about myself so you know why you should listen to me? I started my investing career in the year 2000 at the height of the internet bubble. Not the best moment in time to put my money in the market, but I learned a lot from it. And it set the stage for me to learn what the market can do to you if you're not prepared and not knowledgeable about what you're doing. The stocks and mutual funds I bought at that time lost a big part of its value, and I was totally devastated, realizing it would probably take me years to earn the money back. However, my fascination for the stock market was much bigger than my frustration, and I didn't give up. Instead, I decided I would learn everything possible that this would never happen to me again. By the way, my first stock that I bought during that year was General Electric. At that time, I was working for GE in Germany as a financial analyst, and I believed in the company. But guess what? The market didn't care what I believed. Over the years, I learned the basics of investing and trading simply by reading and studying financial magazines, books, newsletters, and going to investment conferences. In 2002, I changed jobs and started working for Allianz Global Investors, the biggest mutual fund company in Germany, ranking as a top 5 global active investment manager. I worked there in financial controlling for 4 years. During this time, I decided that I wanted to become a fund manager. While working, I studied for 12 months with the German Association of Financial Analysis and Asset Management to get a degree as a certified international investment analyst and as a certified European financial analyst. However, after completing the program, it turned out it was far more difficult to change my career than I had thought. After 1 year of trying, I suddenly got an offer to be promoted to become the head of a department within retail controlling, where I was responsible for over $400 million of annual commission payments to our clients worldwide. I took the offer and worked in that position for another 4 years. During that time, I always continued learning about trading and investing in the markets. In 2007, I got my first mentor who helped me getting into leveraged certificates on stocks, which are similar to CFDs. I also started learning about options trading at that time and gathered lots of valuable experience. Being with Allianz Global Investors, I ended up constantly working 60-hour weeks. And so I began forming the idea to actually leave my job and start becoming a professional trader for myself. In 2010, the ideal opportunity presented itself. I left my job and started to work as an intern for the European Trading Academy for the next 12 months, where I learned the ins and outs of futures day trading. The head of the company became my second mentor. I focused on day trading the German Bund future, the E-mini S&P future, and the Euro Stoxx 50 future. In the following year, I got another mentor, this time from the US, to learn more about day trading the E-mini S&P future. In 2012, I started to get into forex trading, which has been my focus ever since, besides stocks, options, and futures. Finally, in 2013, I decided to start helping other people to avoid the common trading mistakes, speed up the learning curve, and help them learn about trading the markets faster than it took me. And so I began mentoring aspiring traders one-on-one. Fast forward to 2018. Today, I am a full-time professional trader, and in the last 5 years, I have mentored 130 people from 5 different continents and 17 different countries worldwide, in one-on-one intensive coaching sessions that usually lasted anything between 2 months and 2 years, depending on the commitment of my students. As you can probably see now, I am very passionate about trading and investing, and also helping other people to do the same. Although I spend most of my time today trading the markets, this training is all about showing you a simple way to build wealth long-term using an investment approach that requires very little time. So now that you know a little bit about my personal background, let's discuss how you can get started. Building a portfolio that allows you to grow your wealth over time while minimizing the downside risk is normally not an easy endeavor. It requires knowledge, expertise, time, and the necessary psychological strength to be able to stay strong through the ups and downs of the market. I want to present to you an approach that eliminates all those factors I just mentioned. You don't need any in-depth knowledge about the market. You don't need to have any experience with investing. You don't need to spend much time with this strategy, and you also don't need to be afraid of investing because this approach has a built-in protection. I learned this strategy about 3 years ago. Up to that point, investing with a long-term approach was never something I spent too much time thinking about. But this suddenly changed when I read Tony Robbins' book, Money Master the Game, in 2015. For those of you who haven't read it, in it, Tony gives you a 7-step blueprint that shows you how to achieve financial freedom for yourself and your family. Those 7 steps have been distilled from the world's most successful financial players who Tony interviewed over a period of 5 years. There are many lessons to be learned from this book, and I highly recommend everyone to read it. But I want to pick one of the most valuable lessons from the book, which comes from Ray Dalio. Ray Dalio is the founder of the investment firm Bridgewater Associates, one of the world's largest hedge funds. In the book, Ray actually shared his exact portfolio allocation that he uses for his high net worth clients. Even though it is a simple investing strategy, I have found that people still have problems implementing it by themselves. So what happens is they read an amazing book but end up not getting the benefits that they should. Therefore, I want to give you a step-by-step guide for implementing this investing strategy immediately. Before we go over the details and how you can implement it for yourself starting tomorrow, I would like to talk about a very important investing principle. The surest way to accumulate wealth is to avoid losing money. You may say, duh, what a big insight. I know this already. And yes, probably everybody would agree. But there's a huge difference between knowing what to do and doing what you know, or in other words, obsessively executing and following it. Warren Buffett, currently the third richest man in the world, has two major rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. And he's not the only wealthy person who follows this principle. Financial titans such as Ray Dalio, I just mentioned, David Swensen, Paul Tudor Jones, they all focus on protecting the downside first. I always tell my students capital preservation is more important than capital appreciation. Let me illustrate this with an example. Let's assume you lose 50% of your money on a bad investment. How much will you need to earn to make yourself whole again? Most people would say 50%, but they'd be dead wrong. Let's do the math here. If you invested $100,000 and you lost 50%, you now have $50,000. If you make a 50% return on that $50,000, you now have a total of $75,000. You're still down $25,000. In reality, you'll need a 100% gain just to recoup your losses and get back to your original $100,000. Depending on the type of investing, this could take easily several years or maybe even a decade. For a more real-life example, let's look at the 20-year performance of the S&P 500 index from 1997 to 2016. I've used the SPDR ETF that represents the S&P 500 index to calculate the performance. In this table you can see the nominal return over this period was 145.83%. These are just the returns of each year added up. But taking compound interest into consideration, the total return came in at 200.75%. As you can see, I've highlighted all the years with negative returns in red, and you see quickly the disastrous effect that the crash of the internet bubble from 2000 to 2003 and the financial crisis in 2008 had during this period. Let's do an exercise here. Just imagine we were able to avoid those negative years I just highlighted and instead were break even, meaning we achieved a 0% return for those years. What do you think the performance would look like then? Take a guess. You'll be surprised what a big impact this had. On the left you can see the previous table, and on the right I now added a new table. I've changed all the negative returns on the right to 0, so you can see that the nominal return for this period without losing years was 232.94% compared to the 145.83% on the left. But taking compound interest into consideration, the total return was a whopping 730.45% just by avoiding those massive losses. That's pretty amazing. So I'm not saying that it is easy to avoid every market correction. The point I'm trying to make is how important it is to protect your downside at any time and put in your best effort to avoid any big losses. I hope it is clear now why we always want to protect our investments. But how are we going to achieve this? Isn't investing always risky? Don't you have to risk a lot of money in order to have the chance to gain money? Yes and no. Let me explain. The ultimate protection for your portfolio is diversification. In essence, it's what almost everyone knows. Don't put all your eggs in one basket, meaning don't invest in only one asset class. When you construct a portfolio by combining asset classes with different risk characteristics and different rates of return, you essentially balance the return you need to achieve with the risk you're comfortable taking. The beauty of diversification is that it can actually allow you to achieve a higher return without exposing yourself to greater risk. So how come? Because different asset classes don't usually move in tandem. In 2008, for example, the S&P 500 fell 38%, whereas long-term US government bonds rose 28%. So if you own stocks and bonds, you took less risk and achieved better returns than if you only owned stocks. So diversification is paramount. One important side note here. You need to be clear that there is no such approach in the world that guarantees you to never lose money. But the best way to reduce your chance of incurring losses is to diversify your investments. Now let's go over how Ray Dalio's asset allocation looks like. In this chart, you can see the unique combination of different asset classes that has withstood the test of time. Ray calls this portfolio the all seasons portfolio because it balances your risk in a unique way so that it performs well in all seasons of the market. You can see there are 5 asset classes: stocks, intermediate US bonds, long-term US bonds, gold, and commodities. You may wonder why only 30% stocks. The reason for this is that stocks are actually 3 times more risky, meaning volatile, than bonds. Why such a large percentage in bonds? Because this counters the volatility of stocks. It's all about balancing risk, not the dollar amounts. Gold and commodities are necessary according to Ray because you need to have a piece of your portfolio that will do well with accelerated inflation, although they have higher volatility. But there are environments where rapid inflation can hurt both stocks and bonds at the same time. So how do you invest in those 5 asset classes? We use what is called ETFs, or exchange traded funds. ETFs are securities that are created to behave the same way as a specific index or collection of different securities. This means that the ETF will track or move in tandem with the securities it is designed to follow. It can track an index, a commodity, bonds, or a basket of assets like an index fund. Unlike mutual funds, an ETF trades like a common stock on an exchange, and ETFs experience price changes throughout the day as they are bought and sold. They typically have higher daily liquidity and lower fees than mutual funds, making them an attractive alternative for individual investors. The ticker symbols for these ETFs that represents the 5 different asset classes are the following: SPY for stocks, we also call this the SPDR, IEF for intermediate US bonds, TLT for long-term US bonds, GLD for gold, and DBC for commodities. So how do you start investing in this all seasons portfolio? These are the steps you have to take. Step number 1, you need to determine your initial investment amount. Step number 2 is to split up the investment amount according to the percentages given and calculate the relevant number of shares to buy. Step number 3 is to go to your brokerage account and place the orders to buy the number of shares calculated. Step number 4 is to rebalance your portfolio at the end of each year. And the final step, number 5, is to go back to your brokerage account at the end of the year and place the orders to buy or sell the number of shares we calculated. Ideally, you start investing at the beginning of the year, but you can start during the year as well. The all seasons portfolio is a buy and hold strategy, which means once you bought the shares at the beginning of the year, you don't have to do anything until the end of the year. That's pretty good. Then the portfolio must be rebalanced. Why is that? Because during the year, the price movement of the different asset classes causes them to have a different percentage compared to the overall portfolio value than at the beginning of the year. We want to rebalance the portfolio in such a way that we create the original allocation. For example, when one segment of the portfolio does well, you must sell a portion at the end of the year. And when another segment doesn't do well, you must buy a portion to reallocate to the original allocation. When this sounds too complicated, please don't worry, I've got you covered. I promised you that this is the easiest way to build wealth with the least amount of work. And to help you, I've created an Excel spreadsheet that does all the work for you. The only thing you have to do is to type in the value of each ETF at the beginning of the year and its value at the end of the year, and all the calculation is done for you automatically. Sounds good? Let's take a look. This is a snapshot of how the spreadsheet looks like. All the yellow fields that you see need to be input by you, and the rest will be calculated automatically. There are formulas in all the other cells, and those fields are protected so you can't mess up the calculations. At the end of this training, you can find a link on this page to download this spreadsheet, as well as an accompanying video that guides you through the template. It's really very simple to use and only takes a couple of minutes. Now, I want to go through the steps 1 to 5 with you again to show you how simple and fast this investing approach really is. Step number 1. Let's assume we want to invest $100,000. Step number 2. We split up the investment amount according to the percentages given and calculate the relevant number of shares to buy. Here you see the upper part of the spreadsheet I just showed you, and you simply type in the investment amount and the value of the different ETFs. You can get those numbers by simply going to Yahoo Finance and type in the different ticker symbols. The spreadsheet then calculates the number of shares you have to buy automatically. This happens in the last column. Step number 3 is to go to your brokerage account and place the orders to buy the numbers of shares calculated. As there are many brokers out there, and I assume that you are familiar with your own brokerage account, I am not going through the process of entering orders here. If you are new to investing and need more help with that, I can show you how to get personal support towards the end of this training. Step number 4 is to rebalance your portfolio at the end of each year. For this, we use the second part of my proprietary Excel spreadsheet. You simply put in the value of the ETFs at the end of the year, and you can get those numbers again from Yahoo Finance, and then the template calculates for you if you have to sell or buy different numbers of shares. Step number 5 is then to go to your brokerage account and place the orders to buy or sell the number of shares we just calculated. Here you have it, the complete step-by-step guide to set up, implement, and manage the All Seasons portfolio. Are you excited? I hope so. You now have the power to take full control of your financial destiny with a very simple to use investing approach, which allows you to build wealth in the future. In case these 5 steps were too quick for you, please don't worry. The video that you can download at the end of the training will guide you through the entire process. So far, we actually haven't looked at any performance numbers yet. Are you curious to see how it performed over the last 10 years? Let's look at the stock market first, and I'm using the SPDR ETF for this. Over a period of 10 years, from 2007 to 2016, the SPDR had a performance of 57%. This includes compounding. The All Seasons portfolio had a performance of 51%. This doesn't seem like a lot at first sight, but remember, this includes the financial crisis of 2008, where the stock market crashed minus 38%. You may ask yourself, what is the benefit of using the All Seasons strategy if we have a smaller return than just buying the stock market and putting all our money in the SPDR ETF? The big advantage lies in the how we achieve this performance. Let's look at the details. Here you can see a comparison of the SPDR and the All Seasons portfolio with the SPDR ETF on the left and the All Seasons portfolio on the right. Let's look first at the SPDR on the left. I highlighted the years with negative returns in red, and what you'll notice is the big sell-off we had in 2008. There was a small loss in 2015 as well, but all the other years were positive, which is great. When you add up the return of each year, you get a total of 63.66%. However, we have to take into consideration the compounding effect over the years, which is shown in the next column. And what you'll notice is that after the loss in 2008, it took this ETF 5 years to recover and become positive again. After a small profit in 2007, this ETF stayed negative for the next 4 years, and only at the end of the 6th year it was positive again. The total compounded return in the end came in at 57%. On the other hand, when you look at the All Seasons portfolio on the right, we see one major difference, which is that in 2008 we only saw a tiny loss of minus 0.17%, which is close to zero. This is the real benefit of having a diversified and balanced portfolio. It protects your capital in times of market turmoil. What becomes obvious is the difference in volatility. The SPDR on the left has double-digit winning and losing years, but the All Seasons portfolio is much more steady and consistent. Especially when you look at the compounded return, you'll see that the performance increased consistently over the years and you didn't have any sleepless nights. So to make this table easier to read, take a look at the following picture. In this graph, the red line reflects the SPDR and the green line the All Seasons portfolio. You see that the All Seasons portfolio actually was ahead of the SPDR for the first 9 years, and only in the last year the SPDR overtook it. This is the perfect example to demonstrate how important it is to avoid losing money, because when you don't, it will take you years to recover. Also, when you invest in the stock market directly using the SPDR ETF, there is one major risk factor that we haven't mentioned yet, and that shows up very clearly in this chart. It is the devastating concept of sequence of returns. It sounds complicated, but it's not. In essence, it means that the earliest years of your investment will define your later years. If you suffer investment losses in your early years, which is entirely a matter of luck, your odds of recovering quickly are stacked against you. And let's be honest, it's not fun to see your investment go down big time, knowing that it will probably take you years to recover. In the previous table, you could see that after the very negative year 2008, it took the SPDR ETF 4 years to become positive again. You can also see this on this graph. It was a really painful long time that you don't want to experience yourself. However, it may depend on your situation if this was a big problem or not. If you're still young, for example, and don't need to access your money in the next couple of years, you may be more relaxed about it and focus more on the potential long-term return than the possible drawdown. But what if you're closer to retirement, or you simply want to have the flexibility and peace of mind to access your money without having to live with the fear that if the market corrects strongly to the downside and you need to withdraw some money, you may have to take a bigger loss in order to do that. So when you think of the comfort, the consistency, simplicity, safety, and the peace of mind that the All Seasons portfolio can give you, I think it's an easy decision which investment approach you want to choose. But let's be realistic. Although 51% over 10 years is a nice return compared to the extremely low interest rates that you currently get at your bank, it is still a relatively small return for a decade of investing. If you have 10 years to retire and invest $100,000 using this strategy, you would have turned that into $151,000. Although this is great, you still can't retire on that. If you have still more time until you want to retire, let's say 20, 30, or even 40 years, then you have time and compound interest working for you. But what if you don't have the luxury of time? The question becomes, is there a way to increase the performance without taking excessively more risk and avoiding the great volatility we could get from a pure investment in the stock market? And the answer is yes. In fact, we can tremendously increase the performance without doing any more work. Well, you may think, what kind of method would achieve such a goal? And the solution is the use of leveraged ETFs. Before you get nervous when you hear the word leverage, let me say a few words about this. First of all, I want to point out that I would never suggest using any high leverage with your savings that you plan to grow for your retirement. Remember, capital preservation is always more important than capital appreciation. So leverage should always be kept very small, and the smallest amount of leverage we can use are double leveraged ETFs. I want to show you how the use of double leveraged ETFs can help us achieve our goal of higher performance, but still have a limited risk using the all seasons portfolio. What we would do is simply replace the 5 ETFs mentioned to you earlier in this training with 5 ETFs that have a leverage of 2. To clarify, double leverage means that if the underlying instrument goes up 1%, this ETF would increase by 2. But it works in both directions. If the underlying instrument goes down 1%, the leveraged ETF would go down 2%. So the use of double leveraged ETFs will create a higher return, but also brings us a slightly higher volatility. But using the all seasons approach, we still have the same benefit of diversification. If you don't want to experience higher volatility in your portfolio, that's totally fine. Then you can simply focus on implementing the unleveraged all seasons portfolio. However, in this case, you may be interested in the amazing stock market timing system that I developed that helps you to not only decrease the volatility but also increase the performance while using it together with the all seasons portfolio. But more to this a little bit later in this training. Let's look at some numbers for the leveraged all seasons portfolio. Using a double leverage should give us at least double the performance of the regular non-leveraged ETFs. But here's the great news. Compound interest will actually increase the performance even more. Here are the numbers. As you can see in the table in the return column, the total return for the 10-year period was 105.7%, a little bit more than twice as much as the 43.6% non-compounded return of the unleveraged all seasons portfolio. However, when we take compound interest into consideration, the total return increases to 156%. Pretty amazing, don't you think? To compare the 3 investment portfolios that we looked at, the SPDR, the all seasons and the all seasons leveraged, take a look at the following graph. Here you can see the orange and the green line from before, which represent the SPDR in orange and the all seasons portfolio in green. Now I've added the blue line, which is the leveraged all seasons portfolio. What you notice when you compare the 2 all seasons portfolio, the blue line and the green line, is that, as mentioned earlier, there will be a higher volatility with the leveraged portfolio. For example, when you look at 2009, we saw a 1.2% drop in the green line from 7.8 to 6.6%, but a 5% drop in the blue line from 15 to 10%. But with that higher volatility, we also get a better performance. You can see the increases of the blue line in the subsequent years after 2009 were much stronger than the green line. And remember, we also have the benefit of diversification. When you look at 2008, the year the stock market crashed, the leveraged all seasons portfolio was actually able to achieve a positive return of 4.1%, which is pretty amazing. The total compounded return was almost 3 times better than the performance of the stock market for this 10-year period. So to summarize, the leveraged all seasons portfolio has a higher volatility than the non-leveraged version, but it gives us a much greater return. As you can see, 156% versus 51%. On the other hand, which is important, it still has a lower volatility than the stock market itself. But what if you don't want to use leverage or don't want to experience any higher volatility because you feel uncomfortable with it? However, you still want to have a better performance than the regular all seasons portfolio. Is there another solution? The good news, yes, it is. You know, when I backtested the all seasons portfolio for the last 2 decades, I took a closer look at the stock market and I saw how big the up and down swings actually were. In the all seasons portfolio, the stock position is only 30%, and therefore you don't get to experience the full impact, positive and negative, of all the stock market moves. Still, each time when the stock market corrects in a bigger way, like minus 15%, minus 20%, 25%, or even more, that part of your portfolio will suffer accordingly. As a trader and investor, I hate to see when a position loses that much money. Even though the other parts of the portfolio, such as the bond market, will likely offset this negative performance, I just felt there must be a way to do better. And so I began to ask myself a very important question. Is there any way to avoid or reduce the negative impact of a declining stock market on our portfolio? And this question was the beginning of a quest. During the last 2 years, I spent hundreds and hundreds of hours backtesting the stock market over the last 20 years, back and forth. I looked at every single trading day there is, more than once. And you know how many there are? There are 252 trading days per year on average. This means there were about 5,040 trading days in the last 20 years. I can tell you that was a lot of work. The goal was to find out if there were patterns that showed up consistently, which would help me to anticipate a correction and then use this insight to avoid the drop in the stock market. After a long time of backtesting and researching, I am proud to say that I succeeded. In my opinion, what I was able to develop is the best stock market index timing system I have ever seen. And I call it PowerTrend. Obviously, I am biased because it was me who created this system. But I can tell you, since I started investing and trading 18 years ago, I have never come across anything like this, and I've seen a lot during this time. How was I able to create a system that allows you to avoid any major stock market correction and crash in your portfolio? It was actually my unique ability and skill of pattern recognition, which I have trained and developed over many years. You see, once you identify consistent patterns in the market, all you have to do is to create rules around those patterns in order to utilize them and then profit from them. As those patterns that I've discovered are quite complex, I ended up creating various algorithms which are simply complex sets of rules to capture those patterns and turn them into a simple investment decision, which is to eventually exit the stock market at specific critical points of a beginning correction and also to re-enter again when the correction is over. The PowerTrend strategy, therefore, can serve as your personal independent crash warning system that identifies a possible trend change and then alerts you before a potential correction or crash. My PowerTrend system should be used in conjunction with the All Seasons portfolio, and by doing so, it will improve its profitability immensely. That's why I've named this system the All Seasons Advanced Portfolio, or short, ASAP. I will show you all the performance numbers in a moment, but before we go into this, let me say a few words about the purpose of this timing system. First of all, PowerTrend is a trend following system, which means we want to stay in the existing trends as long as possible. Technically, there are two trend directions, up and down. As you know already, when the stock market goes down, the regular All Seasons portfolio will let you sit out those downturns in the hopes that the diversifying ability of the portfolio will help you to avoid any major losses. This essentially means that we are only participating or making money when the market goes up, but we will lose money on the stock portion of our portfolio when the market drops. However, from now on, everything will be different for you. The ASAP system will not only protect you from having big stock market losses ever again, it will also allow you to make money when the market sells off or is in a downtrend. When everybody else is losing money, you will make money and grow your wealth faster. You may ask, how do we do this? It's simple, by going short. Let me explain this investment jargon. The term going long is used when we are investing in an uptrending market, meaning we buy at a low point and we sell at a higher point. The opposite is going short, which means we make money in a downtrending market. For this, we sell at a higher point and buy back the position at a lower point, and the difference equals our profit. In practical terms, This process is actually much easier than you think. You don't have to sell short the SPDR ETF and buy it back at a lower point. Instead, we are using what's called an inverse ETF. The inverse ETF of the stock market, which has the symbol SH, would increase in value when the market drops. So when the power trend system gives you a signal that the uptrend in the stock market is over and we are changing into a downtrend, we sell the SPDR and buy the SH ETF. When the downtrend is over, we switch back and sell the SH and buy the SPDR. Pretty simple. So how does the All Seasons Advanced portfolio compare to the original All Seasons portfolio? The ASAP approach is also a buy and hold, mostly passive investment portfolio, where we hold the bond market, gold and commodities as a fixed position the entire year with no work on your side. So this part is the same as the All Seasons portfolio. In addition, the ASAP has an active stock market portion that lets you ride the uptrends, protects you from any downtrend, and also makes money with any major correction or crash. I hope you start to see that this is a very unique approach to investing, to build your wealth in a simple, stress-free and safe way using the Power Trend stock market timing system. One quick comment about timing the market. You may have heard or read some so-called experts saying that stock market timing is not possible. However, I think it depends on your definition of market timing. Those experts usually say that it's impossible to consistently buy at the low point of the market and sell at the highest point of the market. And I totally agree with that statement. Nobody can predict exactly when a downtrend ends and turns into a new uptrend, and also not when the peak of an uptrend is reached and it turns into a downtrend. And you know what? It is not necessary to do that, and you can still time the market. So how is that? Trend reversals usually develop over time, and the tool that allows you to anticipate those changes in trend is called technical analysis. You see, I look at charts every single day, and I use technical analysis every single day to read the patterns of the market. And you can do this on any time frame really. Whether it's a lower intraday time frame such as the 5-minute, 15-minute, 1-hour or 4-hour chart, or a higher time frame such as the daily, weekly or monthly chart. For us, we only focus on the daily chart. So how does technical analysis work? In short, the stock market or any other market is operated by human beings. And we as human beings are habitual, which means we behave in similar patterns over time. This behavior shows up in the charts of any instruments, whether you are looking at a stock market index like the SPDR, a bond market index, commodities, you name it. And technical analysis uses specific charting tools to read those patterns and make them visible. At least for those who know how to use those tools. So when a trend change begins and before it turns into a nasty correction or crash, technical analysis gives me a warning signal and tells me to get out. To be clear, it took me a long time to become an expert at reading the charts. If you had given me a chart 18 years ago when I started investing, I wouldn't have seen or understood anything. To learn, understand, and successfully apply the different technical analysis tools, it takes years of practice and experience. I can say that I spent easily more than 15,000 hours looking at charts during my investment career, so I know a few things about charts and patterns. Before we go over specific chart examples for Power Trend, let me explain some investment jargon. When any market falls by at least 10% from its peak, it's called a correction. But when a market falls by at least 20% from its peak, it's called a bear market. Now, let me show you some chart examples that illustrate the enormous potential of the Power Trend stock market timing system. Let's go over the most dramatic stock market experiences for most people in the last 2 decades. First, the burst of the internet bubble and the subsequent crash of 2000 to 2002. And second, the meltdown of the financial system in 2008 and the following stock market crash that caused millions of people to lose their hard-earned retirement savings. Here's the chart of the SPDR ETF from 2000 to 2002, which shows that the stock market lost 50.52% during this bear market from its peak to its trough. Pretty devastating. In case you wonder, this is a weekly candlestick chart where every candle represents 1 week of trading. PowerTrend did an amazing job during this bear market, and it would have saved you from a dramatic loss in your portfolio. So what did PowerTrend tell us to do during this time? Actually, during these 3 years, there were various long and short trades, as the market never only moves in one direction, even in an overall bear market. But instead, it rather moves in waves up and down, as you can see on the chart. When those waves or mini trends are strong enough, PowerTrend can give us a long signal even in the bear market. Now I want to break down the 3 years and look at them separately. In the year 2000, PowerTrend gave us 6 trade alerts, 5 winning trades and 1 losing trade, with 3 bullish and 3 bearish trades, for a total of 11.8% profit if you had traded the SPDR ETF. A regular buy and hold investment would have experienced a loss of minus 10.89%. That's almost 11%. This is a huge outperformance of over 20%. To make this point clear, if you had invested 100% of your portfolio in the stock market with the buy and hold approach, you would have lost 11%. PowerTrend, however, would have achieved a profit of 11.8%. Remember, in the All Seasons portfolio, we only invest 30% of our money in the stock market, which means by holding the SPDR the entire year, you would have suffered a loss of minus 3.27%, which is 30% of minus 10.89%. On the other hand, the PowerTrend strategy would have achieved a positive return of 3.5%, which is 30% of 11.8%. Pretty good. In the following year, 2001, PowerTrend gave us 4 trade alerts, 3 winning trades and 1 losing trade, with 2 bullish and 2 bearish trades, for a total of 15.04% profit if you had traded 100% in the SPDR, compared to a loss of minus 12.67% with a regular buy and hold approach. Again, a huge outperformance. In the ASAP portfolio, the stock portion would have gained a return of 4.5% compared to a loss of minus 3.8% for the SPDR in the All Seasons portfolio. In 2002, PowerTrend had 5 trade alerts, 4 winning trades and 1 losing trade, with 3 bullish and 2 bearish trades, for a total of 19.8% profit if you had invested 100% of your portfolio in the SPDR. A regular buy and hold approach would have produced a loss of minus 22.58%. That's a huge difference. In the ASAP portfolio, the stock portion would have gained a return of 5.94% thanks to PowerTrend, compared to a loss of minus 6.77% for the SPDR in the All Seasons portfolio. Now let me summarize those 3 years in the next picture, because I really want you to see how PowerTrend dominates a regular buy and hold strategy. In the upper part, you see the performance of a buy and hold investment over those 3 years that would have put a big dent in your portfolio if you had invested 100% in the SPDR ETF. PowerTrend instead produced consistent gains during this period, so this would have been a time to leapfrog to the next level of wealth, while others suffered terrible losses. In the lower part, you see the results the stock portion of the All Seasons portfolio and the ASAP portfolio would have achieved, which is simply 30% of the performance in the upper part. As you could see from those charts, in order to protect yourself from major losses, you don't have to time the market perfectly, meaning you don't have to exit at the highest point, which we know already is not possible. The same holds true for when the market has reached the end of a downtrend and we want to get back long again. Quite often, the market moves away a significant distance from either the high of the trend or the low of the trend before PowerTrend gives us a new signal to exit and go the other way. But this doesn't really matter. The system was still able to outperform the stock market, especially in times of market turmoil. What about 2008? Similar picture. While the stock market lost minus 49.38% from its peak to its trough, Powertrend told us to exit the market from the beginning of the year, protecting us from a terrible loss. In fact, Powertrend already told us on December 12, 2007 to exit and go short. In total, there were 3 trades with Powertrend in 2008 as indicated on the chart. 1 short, 1 long and another short, adding up to a profit of 42.81% if you had invested 100% in the SPDR. A regular buy and hold approach would have produced a loss of minus 38.14%. In the ASAP portfolio, the stock portion would have gained a return of 12.84% compared to a loss of minus 11.44% of the SPDR in the All Seasons portfolio. By now, I hope you see the huge difference between a merely buy and hold method and the Powertrend strategy, which can help you to achieve much better returns, which translates into you building your wealth faster and becoming financially free earlier. The performance numbers so far have been calculated based on going long and short the SPDR ETF. As mentioned earlier, instead of going short the SPDR, it is more practical to simply buy the SH ETF, which is the inverse ETF for the stock market. Unfortunately, I can't show you those charts for 2000 to 2002 as the inverse ETF didn't exist at that time yet. The SH ETF was only created on June 19th, 2006. But I can show you the SH ETF for the year 2008. The 2 short trades in the SPDR during that year could have been taken with 2 long trades as shown in the chart, and you would have profited nicely from this bear market. Now you've seen how Powertrend was able to successfully navigate through the worst of times in the last 2 decades. But what about other times? Let's look at some more examples. The financial crisis of 2008 continued into the beginning of 2009 as shown on the chart, and it hit its lowest point on March 6, 2009. From there, the stock market was only going to the upside for the rest of the year, and we ended it with a gain of 24.12%. How did Powertrend do? It produced 2 trade alerts, 1 bearish and 1 bullish, both of them winning trades for a total of 35.15% profit if you had invested 100% in the SPDR. This is more than 10% outperformance than the regular buy and hold approach. In the ASAP portfolio, the stock portion would have gained a return of 10.54% compared to a profit of 7.2% for the SPDR in the All Seasons portfolio. What about more recent times? Let's look at the last couple of years. 2015, for example, was a very non-trending year, characterized by narrow trading ranges where every trend-following system would have had challenges. The stock market closed the year with a loss of minus 2.83%. Powertrend, on the other hand, had 3 trade alerts, 2 winning trades and 1 losing trade, with 2 bullish and 1 bearish trade, for a total of 3.97% profit if you had invested 100% in the SPDR. In the ASAP portfolio, the stock portion would have gained a return of 1.1% thanks to Powertrend compared to a loss of minus 0.85% for the SPDR in the All Seasons portfolio. Let's go to 2016. In 2016, Powertrend gave us 5 trade alerts, 3 winning trades and 2 losing trades, with 3 bullish and 2 bearish trades, for a total of 21.3% profit if you had traded 100% in the SPDR, compared to a profit of only 12% with a regular buy and hold approach. Again, a big outperformance. In the ASAP portfolio, the stock portion would have gained a return of 6.39% compared to a return of only 3.61% for the SPDR in the All Seasons portfolio. I could go on and on with these trade examples, but I guess you get the point. Powertrend is clearly superior to a regular buy and hold investment. This means that our ASAP portfolio that uses the Powertrend timing system to manage its stock portion should perform much better than the traditional All Seasons portfolio. I hope you didn't get dizzy with all those numbers. The main point really is Powertrend does an amazing job in not only protecting you in bear markets, but also allowing you to keep building wealth during those times when other people lose a lot of money. Let's look at the numbers and see how ASAP performed over the 10-year period we analyzed earlier. Let me bring your attention first to the crash of 2008. Look in the return column. You can see that the ASAP portfolio was able to create an astounding positive return of 23.88% due to the unique power trend timing system. Remember, the stock market had a huge loss of minus 38% during that year, while the All Seasons portfolio had only a tiny loss of minus 0.1%. So comparatively, ASAP showed a remarkable outperformance. To compare the three investment portfolios, the Spider, the All Seasons, and the ASAP portfolio, take a look at the following graph. Here you can see the orange and the green line from before, which represent the Spider in orange and the All Seasons portfolio in green. Now I've added the blue line, which is the All Seasons Advanced portfolio. What you notice when you compare ASAP and the All Seasons portfolio, the blue line and the green line, is that they have very similar low volatility to the downside, while the ASAP model has reached a far better performance. In fact, the compounded return for ASAP was almost 2.5 times the return of the All Seasons portfolio, 121.8% versus 51%, and a little bit more than 2 times the return of the Spider. Using ASAP, a $100,000 investment would have turned into a $221,800 nest egg, far better than the $150,800 of the All Seasons portfolio. And we are only looking at a 10-year period. Imagine what the performance would look like if you invested for 20 or even 30 years. This would allow you to truly build the wealth you desire. But I have a surprise for you. You remember when I mentioned that power trend should be used in conjunction with the All Seasons portfolio? I want to show you another way in which you can increase your performance by using power trend as a standalone system as well. The stock portion of ASAP is only 30%, and we don't want to increase that as this is part of the unique asset allocation model from Ray Dalio. But let's assume I have another $10,000 to invest. What I could do is to allocate this $10,000 completely to the Spider ETF and manage it with power trend. This way, the smaller portfolio of $10,000 would grow at a rate of 100% of the performance of the stock market, and not only 30% like the All Season or ASAP portfolio does. What does this mean in numbers? Let's look at the returns of the Spider managed with a power trend strategy over the same 10-year period. As you can see, while the nominal return was 200%, the compounded return reached an astounding 493.17%, almost 500%. This means that my $10,000 investment would have grown into $49,317. The amazing thing is that the power trend strategy was able to produce a positive return every single year. Now the volatility for this investment will be higher than the ASAP portfolio, but it will still be lower than the volatility of a regular buy and hold unmanaged stock market investment with the Spider ETF. To clarify one point, I am not suggesting that you take more risk than you want to. I merely want to show you the options you have on how to make use of the power trend system. We all know that every person has a different risk appetite when it comes to investing their money. Generally, people are willing to take a higher risk when they are younger, which means they are willing to accept a higher volatility in their investments. But in the end, this is always a very personal choice. If you are uncertain about which risk you should take, please talk to your financial advisor, as this usually depends on your personal situation and your investing goals. Let me give you a quick overview of the 3 investment approaches we've discussed so far. First, the All Seasons portfolio, which is a unique diversified portfolio. I've laid out all the steps in this training so you can implement it starting right now. You can also download my proprietary rebalancing Excel template at the end of the webinar. Second, you can improve your performance and create wealth faster by using the All Seasons Advanced Portfolio, which has the same benefits as the All Seasons portfolio, with the difference that we are managing the stock market portion actively using my PowerTrend timing system. And third, you can use the PowerTrend strategy as an independent system to manage your stock market investment in the SPDR ETF. So by now you probably ask yourself, how can you get your hands on ASAP and the PowerTrend system? I was thinking a long time about offering the opportunity to teach the system to other people. However, as I mentioned earlier, it is based on complex algorithms that would take an inexperienced investor a long time to learn. And if they learned it, it would still be hard to implement it consistently the right way. Put aside the fact that you have to look at the system at least once a day when the market has closed. So instead, I decided to make it really easy for you. I decided to take all the work away from you and offer you the comfort of getting the trade alerts delivered to your inbox via email and SMS each time the PowerTrend system has detected a trend change in the market. As you've seen already, this is not an intense trading service where you constantly have to place trades. It's the opposite. We want to take advantage of the medium to longer term trends in the stock market. So there won't be too many trades. In fact, over the last 20 years, there was an average of 4 to 5 trades per year, with as low as only 1 trade and as high as 9 trades per year. So you can see that it's not that much work on your side at all. But this also means that you cannot miss any of the signals that PowerTrend gives you, because they are crucial in order to protect your portfolio and take advantage of potential downtrends. The retail price to access ASAP and the PowerTrend strategy is only 197 euros per month. But there is more. Here's one thing I learned from many years of coaching people on how to trade and invest. When you are not that active with your investments, it's easy to forget about them and slip into the mindset of out of sight, out of mind. And you may even start to not think about or even care about them that much anymore over time. Just think about the following example. A lot of you may have an automated retirement savings plan where a fixed amount of money is deducted every month from your paycheck to fund your investment account. While this automation is great and can really help you to save consistently over time, it can also lead to you feeling a little bit out of touch with your investments. You are saving and investing for the long term, so you don't really see and feel an immediate effect of your savings effort, and as a consequence, you lose the sense of urgency. My goal for you is to empower you to be in control of your investments and take responsibility for them, because your future depends on it. I want to help you stay committed to your investments and cultivate the sense of urgency within you that is so necessary to succeed in the long run. And in order to achieve this, I want to offer you something very special today. I want to offer you to meet with me on a weekly basis. Yes, you heard it right. I would like to do a weekly coaching call with you, in which we will review the status of the ASAP portfolio, look at current market conditions, where you can interact live with me, and most importantly, you can get all your questions answered that may come up. I've been coaching and mentoring people from all around the world for the last 5 years. I know how important it is to have someone by your side that supports you mentally on your investing journey. It's so easy to give up when you're all by yourself. When you look at the news every day, you can quickly get nervous and start worrying about the future of how the market's going to react. You know very well, when you get emotional about your investments, you tend to make the wrong decisions. I want to help you navigate through all seasons of the market, whether it's a calm trending market or a rough volatile up and down. In addition, I also want to serve as your accountability partner who reminds you about your commitments, who helps you stay connected to your investment goals, and who helps you remain calm in times of market turmoil. This is a service that not many people are willing to offer, and if they did offer it, they would charge a big amount of money for it. I assume most of you may be investing in mutual funds. Just try to call your mutual fund company and ask them if they could do a weekly conference call with you to keep you up to date on the market, tell you how your mutual fund is doing, and especially to warn you before the next correction or crash. I guess all you would get at the other end of the line is a laughter, or they may just hang up. I think you get the point. I want to be your investment coach who helps you to implement the ASAP portfolio and who is by your side personally while you build wealth long term. You see, if I wanted to make my life easier, I would just offer the Trade Alert service by itself and that's it. But I really care about your investment success, and I know from experience that having a coach and mentor with you every single week will help you win the game. Just imagine how simple your wealth building journey could be by using ASAP and the Power Trend system. You never have to worry about any market crash again. Having account crippling losses could be a thing of the past. One thing that is certain is that there will always be another crash or a bear market. But you are prepared and can stay completely relaxed. People are afraid of the stock market because they are afraid of the uncertainty that comes with it. You learned today that there is an easy way of overcoming that uncertainty, and instead invest with confidence and a calm and certain mind. The price of these weekly coaching and mentoring calls is 497 euros per month. To give you a comparison, I normally charge 250 euros for a 1-hour coaching session. But there is more. When you order ASAP today, you will also get 3 additional bonuses. Bonus number 1, first, you will get lifelong updates of the Power Trend system. You see, a lot of people buy cheap investment programs or robots because they fall for the lie that they could get rich quickly. What they overlook is that most of the time those robots only work for a limited time because they are flawed from the beginning. They are not backtested sufficiently in all kinds of market environments, and therefore when the character of the market changes, the program stops working. Also, the person who they bought it from usually never updates the program, which means they are already set up for failure the moment they buy it. Power Trend, on the other hand, has been backtested for decades through every type of environment you could imagine. The worst crashes in the last decades, choppy sideways trading ranges for many months, and the longest bull market we've seen in a very long time from 2009 until today. Also, I should mention, I'm investing my own money with ASAP as well. So I have a very high interest in keeping the system up to date all the time. Bonus number 2, the current version of Power Trend protects you from crashes and major corrections. As you remember, corrections are when the market goes down by at least 10%. But what about all the corrections that are smaller than 10%? For the last couple of months, I've been working on a way to anticipate all these smaller corrections between 5 and 10% as well. I still need to finish some more testing, but as soon as I'm done, you will get it for free. There are usually several smaller corrections every single year, and so far we just sit them out, because 80% of the corrections are over quickly and never turn into a bear market. Only 20% of the corrections become real bear markets. What this means for you is you will be able to benefit from those smaller corrections and add a few more percentage points to your profit every single year. Bonus number 3 that you're going to get: as a trader and investor, I am always looking to improve my systems and strategies all the time. There is always a next level. So what's the next level for ASAP? Expanding Power Trend to the bond market. My plan is to move from a passive buy and hold investment in TLT, which is the ETF we currently use in ASAP, to an active investment approach. You saw how Power Trend did for the stock market. Can you imagine when we use this system for TLT as well? My first tests have shown already amazing results. There is still a lot of work to do, but from how it looks today, you will be in for a treat. Once Power Trend goes live for TLT, you will get free access to it as a member of the ASAP family. When you add everything together, Here's what you're going to get when you say yes to ASAP right now. Unlimited access to the Power Trend trade alerts with specific entry and exit signals, so you know exactly when to be long or short the stock market, valued at 197 euros per month. Weekly group coaching sessions where we review the status of the ASAP portfolio, look at current market conditions, and where you can interact live with me, valued at 497 euros per month. Unlimited access to the ASAP members website, where all the recordings of our live sessions are posted, as well as any bonus material, valued at 27 euros per month. Having an accountability partner who helps you stay in touch with your investments and who reminds you to keep your commitment towards your investment goals, especially in times of market turmoil. Valued? Well, this is priceless. Bonus number 1, you will get lifelong updates of the Power Trend system for the stock market, valued at 47 euros per month. Bonus number 2, receive the Power Trend signals for smaller corrections in the stock market, valued at 97 euros per month. And the final bonus number 3, the Power Trend for TLT to push your performance to the next level, valued at 197 euros per month. The total value of everything in this amazing system is 1,062 euros per month. If all this system did for you was protecting you from the next 20 to 50% drop in the stock market, would it be worth it to you? Picture being able to stay calm, relaxed, confident, feeling safe, and being in total control of your investments from now on. Would it be worth 1,062 euros per month for you? Just imagine having an amazing system and coach by your side all the time, which will allow you to never having to worry about your financial future again. Would it be worth 1,062 euros per month for you? But if you join today, you don't have to pay 1,062 euros per month. As I said earlier, I really care about your future investment success, so I want to give you a very special offer. I am willing to give you the coaching sessions and all the bonuses for free. And you can sign up today for only 197 euros per month. That's a whopping 80% savings from the normal retail price. Now, in addition to the 80% discount, I want to make this a completely safe decision for you without any risk whatsoever. So I'm going to give you my 100% 30-day money-back guarantee. If you feel you don't get value from my system and coaching, then I don't deserve your money and I'll cheerfully refund you 100% of your tuition. Just send an email to support@asapinvesting.com within the next 30 days and I'll issue a full refund. Now, I know that there may still be people out there who would love to take advantage of this service, but say that they simply can't afford 197 euros per month. And I get that. So here's the deal. My mission is to help as many people as possible to avoid not only the next correction and crash in the market, but every correction and crash from now on, so they can thrive in those times and build their wealth faster. This program will give me the chance to change thousands of people's lives, including yours. So if you want to become a part of this group, an official member of Team ASAP, I want to make you an incredible offer that's only valid for today. It's not going to cost you 1,062 euros per month or even 197 euros per month. You can have my system and me as your coach and mentor for only 49 euros per month, which is only €1.63 per day. That's it. There's no upsell and literally nothing else to buy, which means every single person watching this can afford to participate. But you have to act today. And to make your decision the easiest possible, you can join right now for just €1. Hang out for 2 weeks, and if you love the experience, do nothing. You'll be billed just 49 euros per month for as long as you'd like to stay. If you decide it's just not right for you for any reason at all, whether it's next week or 6 months from now, just send an email to support@asapinvesting.com and you'll never be billed again. So basically, you have nothing to lose by saying yes. On the other hand, if you don't do something today about how you manage your money long term, nothing will change. Your life will stay the same, and when the next market correction comes around, you'll be hit again, and you will suffer another financial setback. As Albert Einstein said, the definition of insanity is doing the same thing over and over again and expecting different results. In other words, if you keep investing like you've always done, you get what you've always gotten. Mediocre performance, no protection in your portfolio, and the risk of devastating losses. Change your financial future today. This is a unique opportunity, and I hope you will use it. So click the link below right now to join for just €1, and let's make 2018 your breakthrough year. And remember, you are completely covered by our risk-free 100% 30-day money-back guarantee, so you have nothing to lose and everything to gain. Thank you so much for joining me here on the webinar today. I am looking forward to helping you build your wealth, and I'll see you on the inside.